the Federal Reserve, because of their lenient policy, and really the government because of their spending, they've basically made it so you've conditioned the retail investor to buy every little dip. Like as soon as you get money in, if you can afford to, it goes right in the market, because even if we get a 10% dip like we got in early August, the markets recovered almost fully within 2 weeks. When we saw COVID, the markets cratered, 30%, and then they recovered and went into all-time highs. And so we haven't seen one of these sustainable long periods where markets don't recover, and it's conditioned smaller investors, especially the younger generations, to just say, hey, just keep going in. Don't worry if you're down 5 or 10%, just hodl, right? That's the new term in the crypto markets. And I'm really concerned that ultimately will be a major factor in the ultimate undoing of this investment strategy. Because I think what's going to happen is just like in 07, right? 07, 08, 09, people got pushed, like the strongest holders of equities at the lows in 09, the markets fell so fast and so hard that people got whipped out. They finally threw in the towel. And where do they throw in the towel? At the lows. And so this is the way the markets work. The markets always make it trickiest on us. They push people to their limits. And I do think that the Federal Reserve is to blame in a way for letting the markets or helping the markets recover so readily so many times here.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode. Okay, so to wrap up this part of the interview, let's stick with a near-term time horizon, say year's end, right? We're coming into September right now. We've got half the year left here of market activity, essentially. Any major catalyst that you see? We've got American election coming up. That could be a big one. Any implications behind that you think are relevant and should be discussed? And then just general forecast, Gareth, balance of the year, market outlook.
Yeah, so I think the election cycle itself is going to be somewhat muted. I think now things are kind of quieting down there. I think prior there was a little bit more angst. It's going to be one of these interesting scenarios where it seems like policies, you might have tariffs if Trump wins, or just more kind of easy money and spending if Harris wins. But it seems like the markets are kind of more reserved to like, okay, that's politics. That's kind of the slow train going down the tracks. The faster one that I think is most important is the Federal Reserve and the U.S. economy, right? So if I'm right and we are close to or in a recession by year end, then I do think the markets are close to a panic. And again, one of the things we've seen, and I showed that chart of the S&P 500 from 07, is that the market, when it makes tops, has these big dips like we saw in August here. And then it recovers very quickly because the buyers just, say, oh my goodness, I can't believe I can get it at 10% discount, right? They buy it right back up. Yeah. But eventually, as it drops again, less and less people buy the dip because they already put all their money in the system. And then, like you said, in general, investors don't want to sell for a 5 or 10% loss until it gets to be 50, 60, 70%, and then they fold. And that's the biggest issue here, is that I do worry eventually we're running out of retail to buy these dips.
That's the fear and greed balance, right? When you're down 5%, you're feeling greedy, like I can make it back. 10%, you're feeling greedy. 30% fear starts to overcome you. Like 30 could become 80. It looks like all of a sudden 30 could become 80, and then fear overpowers greed and you hit the bid at the worst time. Which is why I appreciate your take, because you're very good at stepping back from emotional reactivity and looking at the data. Okay, so yeah, I was looking at some of your charts prior to this interview and just thinking through how vulnerable the market looks right now. We had the Iranian sort of war scare in April, massive sell-off, right? The yen carry trade unwinding in August, massive sell-off. But in both cases, very quick rebounds at the same time. And you got to wonder, like, what is the straw that's going to break the camel's back? Is there one? But and it could just be general recession fears, or post-Labor Day institution decision delayment now being employed, something like this?
Yeah. And I would just say, I think it's a little of everything, right? It's going to be the straw, multiple straws that ultimately break the camel's back. And I think the big one here is the AI trade starting to become like kind of an afterthought. Not an afterthought, not to say that it's not going to be a significant part of our lives going forward, but just you had these stocks that were growing at, exponential rates, and things over time as they grow just can't grow at those exponential rates as fast anymore. And so even with Nvidia, we saw their earnings were amazing. It just wasn't quite the same growth that they reported last quarter. And probably going forward, I think institutional money knows that that's the way it's going to be. In addition, we're now starting to see an economy that's slowing down. If we continue to slow, then how do you justify, Microsoft, Apple earnings PE ratios in the 30s, right? Historically, a company like Apple would be in the 15 range. I mean, that's a 50% haircut. So even if we don't get to that point, just a reduction into the mid 20s brings the stock market down pretty significantly. And so I think valuations coupled with a slowing economy where earnings numbers come down pretty significantly, that can really be the kicker here. And then you throw in other things like the Black Swan events, right? Is there another war that breaks out? What about China and Taiwan? What about, the debt scenarios? What about the Nikkei and the yen carry trade? Like there's so many things that the market's been ignoring for so long, but eventually I do think that stuff like this will start to matter.